Folks, I am so excited this school community is taking off. This gives me the ability to reach out to rock stars like Bob Langworthy and really get him to answer your questions. Real estate investing offers a lot of kind of tried and true practices, get a buy box, daily discipline, focus. But heck, sometimes you have very personal questions. And someone that I know, trust, respect, and helps with my taxes, Mr. Bob Langworthy, as well as the lumberjack landlord. So you know he is the real deal if the lumberjack uses him. One and only Mr. Bob Langworthy. How you doing, buddy?
Michael, I am doing well. I'm happy to be back with you on this call and joining the school community.
Awesome, buddy. Well, do me a favor. Not everybody knows who you are. Give a little quick bio. Talk about Maine bean counters. Give them the quick couple minutes so they could research you if they want to reach out after the fact.
Sure, thank you. Yeah, so I started an accounting practice about 15 years ago. I had done a couple of other things prior to that and was drawn to accounting. Started the practice just me, no clients. It's America, so you can do that. And my bachelor's degree is in geology, so I am an enrolled agent. There are
Oh,
two
wow.
designations. Yeah, two designations for accountants. You can either be a CPA or you can be an enrolled agent. Enrolled agents, we get our designation directly from the IRS. Can represent clients, prepare taxes, do all of that. The practice has since grown. We have a staff of 13 in tax season, 8 outside of tax season, including 2 CPAs that work for me on my team and another enrolled agent. But along the way, I got interested in real estate for a number of reasons. My father's a builder, so I kind of grew up around real estate. And secondly, the tax code points to real estate as a fantastic way to make money with great tax advantages. And so I bought my first property 8 years ago. It's an office building. And my accounting practice is one of the 4 tenants there, and we lease out some parking spots. And then I moved on to a single family, a duplex, and a quad in a neighboring town. So we have those 7 apartments as well. And we're always looking for more in that area in our buy box, which is it's a 2-town area near us here. You know, when you live in Maine, your buy box doesn't have to be just one zip code. You know, there's only 1.3 million people in the state, so we have a couple of towns in our buy box just so we can have some
Okay,
deal
that's
flow
okay.
for
You're allowed.
transactions. Yep. Yep. And then as we've grown the practice, so one of the CPAs that works for me, he's a real estate investor now, and he started to buy properties. Our office manager has bought her first rental property in Florida, and you know they can't help but see the tax benefits. And so we do work with a lot of real estate investors and small business owners, and many folks have found us through you, Michael. So thank you for that. And we have just reopened to new clients. We have staffing issues in our industry. So we were closed to new clients from about the middle of December until the middle of last month, and we're open to around 150 more. We think that's what our capacity will allow us to serve in the coming year, and we are working through that. And we have a screening process now that we go through to make sure we're going to be a good fit, and then we can really add value. That person that comes to us with a couple of W-2s, we can do that return. It's just we're not really going to be able to do much tax planning for you and
Yeah.
really provide meaningful value.
Yeah. Yeah, this is, anybody can go back on my channel. Anybody has accounting questions, certainly real estate related. You'll always hear me say either Bob Langworthy or Maine Bean Counters. They are one in the same. Bob is the person, Maine in the state. Maine, the state is the firm. So I appreciate all of that. Again, folks, remember this is for you. You can either raise your hand here in Zoom or put a comment below. We're going to riff until you guys get some comments in. I don't see any chats or hands raised. Oh, we do have a hand raised. We'll go to Lars. Lars, let me go ahead and, oh, you're unmuted. Go ahead.
Hi, hey, thanks for doing this call. I have a
Of course.
question, and that is, my understanding is that you do a lot of that you do trust or help advise on trust as well. Is that correct? Before I ask my question.
So my answer is a little, it's a mixed answer. I can't advise on trust because I'm not an attorney.
Right.
I do work with clients that have trusts that hold real estate in a trust of one sort or another, and we will do those tax returns. But in terms of whether your property should be in a trust or not. I can't give legal advice because of the industry that I'm in.
Okay, all right. Well, that tells me how I should phrase my question. No problem.
Yeah,
Okay.
fair enough.
Okay. Yeah. So for real estate investors who, I mean, I work in banking, so I see a lot of people with trust and that kind of and that stuff. For real estate investors that have, that you see that have trust and put them in trust, do you normally find them in living trust, or do they, or like, what's the most common trust you see real estate
Sure.
investors have their real estate held as a way to, obviously with taxes, but also as a way to protect their kids that they're gonna pass it on to?
Yep, it's a good question. I can't answer that question for you, Lars. So the most common trust structure that I see for clients is a revocable trust. So that would be a living trust. That means
Right.
they can make changes to it at any point. It does not require a separate trust tax return, which is a benefit for them. So it is just a pass through onto their 1040 on a Schedule E. If that's how the property is owned. So it's very straightforward. The joke in our office is that you set up a trust when you don't trust somebody. That's the irony of the name, right? So you would set up a trust in this case because you don't trust your kids to own those properties right now, but you would like them to in time, upon your passing, the passing of your spouse if you're married. And so it is a good structure. There aren't tax advantages per se when you have a property in a trust. It has the same tax treatment. It is upon your death that there can be some streamlining and some tax advantages at that point.
That help, Lars?
Yeah, that helps. Yeah, I just had to kind of rephrase my question there, so no problem. But yeah,
Yeah,
thank you.
appreciate you, man. I'm going to put you, oh, you're back on mute. Very, very cool. We're going to go to Joe next, and then we'll go to the comments. Again, folks, if you raise your hand, put chats, I'll get to you. Joe.
Thanks so much. Hi, Bob. So a little bit about my situation. I have 6 long-term rental properties in Texas. They're in what's known as a Series LLC. Are you familiar with Series LLCs?
I am, although we don't have any clients that have a Series LLC. I'm not sure why, but we
Okay.
just don't. We don't have any of those currently.
Okay. So here's my situation. So I have a property management company that I've contracted to. They take 8% of top line. And every month they provide me an owner statement. And on that owner statement, it's a PDF, right? So and it's a separate owner statement for each property. Each property has a separate bank account, all under that Series LLC. So you have your Series, you have a cell for each property, separate bank account for each property for asset protection. And I received this PDF statement, and let's say each property received $3,000 in rent, and in one property there were maintenance tickets valued at $800 for the month. So I receive a debit of $2,200 in my account automatically from my property management company. Where I'm struggling is in QuickBooks, right? How do I reflect all of that? Not only from a receipt standpoint, but all that QuickBooks is seen as a $2,200 debit for that one specific property in that hypothetical example.
Sure.
So I'm open to feedback from you. Now I've hired a bookkeeping company just to try to scale this as much as possible. I think I pay them like $200 or $250 a month just to manage the books all up, but it's been a disaster and it's been really challenging. So
Yeah.
I'm looking for advice on what you would suggest in this situation.
Sure. Well, let me address the structure and then what you're trying to do, and then I'll answer the question. So I like the structure. You're doing the right thing by having the separate bank accounts, property management in place at 8%. That's not bad. Working with a bookkeeper is a good idea. And what you are highlighting, and I'll speak to it briefly for those on the call who might not be in this situation. When you receive a statement from a property management company, you can't just send that to your accountant at year end, because it's missing an awful lot of information. And that's
Yes,
what
it
Joe is
is.
trying to capture in QuickBooks. He's trying to capture things like the mortgage payment that maybe he's paying and not the property management company, and
Right.
property taxes and insurance, and then all the balance sheet items that happen. So maybe the repairs are being paid for the property management company, but maybe he pays for the new roof directly, and that's not through the property management company because there aren't enough funds in that account. And so by using QuickBooks, Joe can then capture all of the transactions in one place and have a much more meaningful bookkeeping record to hand off to his accountant at year end. So I appreciate that you are on top of this, Joe. This is a great question. There are broadly two different ways you can handle this. You can record the $2,200 as a debit, as income in your account. I prefer to do a little more work because I would rather know that I had 3,000 in income and 8,000 in repairs for that property.
800.
Yes, thank you. 3,000 in income and 800 in repairs for that property, because that's more meaningful to me than just 2,200 in income.
Yeah,
Because I
exactly.
can run more analysis on these properties with the more detailed information. So your bookkeeper is just going to need to do that, slightly more work. So the other issue with QuickBooks Online, and this is something you can talk over with your bookkeeper, is that you can connect your bank account and import transactions. And the problem with that arises when that $2,200 shows up in the bank account, and now you're trying to import that into QuickBooks, and QuickBooks is only going to call it rent of $2,200. So you can,
There you go. That's the challenge.
not hard to do. When that $2,200 gets imported, your bookkeeper can then just go into that transaction and add a line, adjust the 2,200 to 3,000, and then add in the $800 repair. It'll still be $2,200. It'll match up when there's reconciliation, and then you'll have a much better top line number for your rents across all your properties, on which that 8% is calculated. And you'll have a better idea of repairs per property by adding that extra amount of detail.
Yeah, Joe,
Okay,
the other
that
thing,
makes sense.
so Joe, let me ask you a question because I was in your
Sure.
situation. And I'm going to guess, I don't know Appfolio, but I'm going to guess it's like the other stuff. So I'm the same story, right? Got a bunch of houses, each are individual, have a property manager. Shoot, I paid 10% in the beginning. I didn't get 8% for years. And again, I would get a report that says, hey, you got $7,000 in your account. Congrats. What I ended up having to go back to them, I'm saying, that's not helpful, right? Which is basically what you're saying.
Yeah.
That's not helpful. I can't tick and tie. I can't track things. It's a problem. So ultimately, through just sheer questions, I realized that I needed to ask for what was called the general ledger report, the GL report.
Mhm.
So it's a different report that the property manager typically doesn't send out because it's line items. It would actually say 123 Main Street, collected 3,000 rent, June 2nd, $800 invoice, blah, blah. So it's far more detailed, but that's what you want. You want the detail. You want the bookkeeper to put them. So I'm going to challenge you to go back to your property manager and say, hey, can I get a general ledger report for each of my properties? My guess is it's there. Maybe they just didn't know that's what you're looking for.
Okay. And is that typically an Excel sheet that you would get it, or just a PDF? Does it matter?
So in the beginning, it was a PDF because I've been doing this 20 years. They didn't have an Excel export. Now they do, or at least in the app that I have. But in the beginning, I've talked about it, right? We got a paper. What I would get in the past was a GL. This is 2003, 2004. I get a GL report and I would get faxes of receipts. You don't have to do that now. Everything's uploaded. But yeah, I think all you want is the property manager to send you the GL.
Okay. And then I'm just gonna have to manually export each receipt, right? And then send that all to my bookkeeper, and they're just gonna have to obviously upload it all into QuickBooks and everything like that.
Yeah, it'll probably be two different files. I'm going to guess Appfolio has a GL report, and then you're going to have to get the receipts that tie to the GL. So I'm guessing it'll be two different files.
Okay. This has been really helpful. Thank you so much.
Bob, does that make sense?
That makes a lot of sense. Yeah, thank you, Mike. And just one follow-up on that, Joe. You might be able to get the property manager to send the files directly to the bookkeeper.
Ah, good point. Yeah, true.
Maybe CC you on it because you do care, obviously, with a question like this, but that avoids a little bit of work for you.
Yeah, that's fantastic. That helps scale it a lot more. Thank you so much. Much appreciated. This has been great.
You're welcome.
All right. Very cool, man. All right. We're going to go to question in the chat. Joe, do me a favor, lower your hand so I don't get distracted later. So we've got a question from Mark. Are there any upcoming tax law changes that could impact real estate investors? Oh, that's interesting. Bob?
That's a great question. There is the enormous one that happens at the end of 2025. We're under the Tax Cuts and Jobs Act right now. So whoever gets into the White House in November, and whoever is in Congress at the time will control the next big piece of tax legislation. So there are a lot of, well, the entire Tax Cuts and Jobs Act sunsets. So there are a broad number of things that'll happen then. We don't know what those are. There are things that get kicked around every now and then, but frankly, Congress doesn't pay a whole lot of attention to tax law until the very end of the year. So I don't know of anything pending at the federal level. There are some things that change every year. You know, a big one for real estate investors is that bonus depreciation is in the process of phasing out. So you can now take 60% bonus depreciation. In 23, it was 80%, and in 17 through 22, it was 100% bonus depreciation. So that's continuing to phase out. That's a big one for those looking to do a cost segregation study. And I know there's a question also about depreciation, which we can touch on in a bit. So that's a long way of saying I'm not aware of anything directly impacting real estate investors.
The one that I see get kicked around a lot, kind of my standpoint, and again, is the 1031 exchange, right? Where they're talking about killing it. I suspect that the 1031 change, worst case, has a dollar threshold, right? Basically, what they want to do with the 1031 is stop the big guys from using it, right? Nobody on this call, you know, myself included, counts as a big guy, right? We're talking thousands and thousands of units.
Right.
That's possible. They might do that.
And
but they're always
related to that is the step up in basis.
Oh, stepped up basis. That's
because
true.
that's viewed as a benefit for the wealthy. And
correct.
So Congress will want to pass things that they have good optics, that feels like, oh, this is only going to affect these rich people over here and not you guys. And so possibly the step up in basis upon death would be eliminated as well.
That's a good. I'm glad you brought that up. If you were to, you know, make me choose, I think there's a better chance that they get rid of stepped up basis than 1031 exchange.
I would agree. Yep.
Yeah. So that's something to look at. Here's a good one. This is definitely an accounting question, and I just love it because that's, you know, that's where I started my career. If a real estate investor lost money in a busted syndication, can they use those losses to offset gains? What is the best way to make lemonade out of these lemons of a deal?
Well, you were in accounting, so you know that the answer to most of questions in accounting is it depends.
It depends, yeah.
And it does depend in this situation. The short answer is yes. You can apply those losses up to your basis against gains in real estate. So I'll just make up some numbers here. You know, let's suppose somebody puts $100,000 into a syndication, and after a couple of years, something happens, it goes bust, and you lose that money. You have a $100,000 basis. You're able to claim as a loss effectively because you're now getting zero for that against your other income. But it's the nature of the income that matters.
Correct.
So syndication is passive income. So that loss would apply against your passive income. And then you can take up to $3,000 a year in passive losses until that loss gets used up. So if you were to enter another syndication, for whatever reason, you know, you've got a stomach for this stuff, and that syndication makes money, and that's a passive gain of $50,000. You can now apply that loss against that gain to neutralize that.
I have even more bad news for you. I have some bad news for a lot of people that got into syndications the last couple of years because of bonus depreciation. Here's the unfortunate problem: is not only could you potentially lose the $100,000, but if you have a complete loss, you are also going to get hit for taxes because you got bonus depreciation. Right. There's this thing called bonus depreciation recapture. I got bad news for you, folks. Some of you guys are going to write a check.
Yeah. And the other piece with this, if it was syndication from probably about 2 or 3 years ago, before the interest rates went up.
Correct.
A lot of them ran their numbers and their projections based on a refinance at rates you can no longer get. And so we could see a lot of trouble in the syndication space in the next 3 to 5 years here as they get towards their exit dates.
Their terms,
we're in trouble. So
So again, folks, if you got into syndication, definitely ask the questions about bonus depreciation. Do not be surprised. It is possible that not only you lost your $100,000 as this example, but you also have a bonus depreciation recapture, which means you might have to write a check. Talk about salt in the wounds. Not good. Not good. Let's talk about optimizing depreciation. This is a good question because there are some things you could do around optimizing depreciation based on your income level, active and not. So why don't you talk about some thoughts there?
Sure. So one of the first things we look at when someone asks about optimizing depreciation is a non-depreciation strategy, which is the de minimis level of write-off. So you can do an improvement of $2,500. So you buy a window, you do a new window, and that $2,500 falls within below that $2,500. Say your window's $1,000, falls below the $2,500 de minimis exemption, and you're able to write that off entirely. So the first thing we do is we want to look at all the low-hanging fruit. Now, from there, the big one for real estate investors is a cost segregation study. That's when you have a firm that looks at the property and decides, of this building property, how much of this should be depreciated over 27.5 years, how much over 5 years, and how much is land improvements that gets depreciated over 15 years. And it's broadly speaking around 25% of the value of the building that can then fall into one of those categories. And then from there, you can either take that 5-year property and depreciate that out over 5 years, and the 15-year out over 15 years, or you can take bonus depreciation, which in 2024 would be 60% of that up to 25% all at once. So just to make up some numbers, let's say your building is worth $400,000. You've got $100,000 now of that is going to be depreciated over 5 years and 15 years. The other 300 is still over 27.5 years. So that of that 100,000, you can now take up to 60% or $60,000 all in 2024. It is a great strategy, but it has to be used in conjunction with a conversation with your accountant about your long-term plan, because it really is, it's a one-time benefit that you receive. And now that property, instead of depreciating $400,000 over 27.5 years, it's only $300,000. So you get less depreciation moving forward. So it is a strategy that we'll use when somebody says, well, my goal is to retire from my W-2 job in 3 or 4 years. Okay, great. Let's see if your spouse can qualify as real estate professional, and we'll take a bunch of depreciation so you can get some refunds. Or perhaps it's a situation where somebody is just, they're a full-time real estate investor and they've got a large portfolio of properties, and you can just do 1 or 2 properties per year to bring down your income. So it is a great strategy to use to optimize depreciation. But as I said, that caveat, it is a one-time strategy. Then should you sell the property and not do a 1031 exchange, you have to pay tax on that depreciation recapture. So the IRS says, hey, remember that benefit we gave for depreciation? We're now going to tax that benefit.
Yep.
So it's a great benefit, but have a conversation with your tax professional about it.
Yeah. Well, I'm going to give you a question out from left field that I get all the time. We've riffed on it before. We're going to do it again. And that is the magic of real estate professional. I have a lot of people, myself included at a time, were like, hey, I make, 6 figures a year. I'm above the threshold. I want to be a real estate professional, so I get all these extra goodies. Let's assume for the moment I'm single, and then we'll pivot to being married.
Sure. Yep.
Generally speaking, you're a high-tech worker, engineer, whatever it is, you're working 60 hours.
Yep.
It's probably not impossible, but it's highly unlikely that you're going to be able to claim yourself being a real estate professional. Is that
if you're working 60 hours in a tech job, you wouldn't be able to claim rep status, because the IRS wants to see more hours in real estate property trades, is a technical term, than your regular W-2 job. So you have to spend 61 hours per week and you're just not going to do that. So with a single person, it typically is either someone who is in real estate, and that can be. So here's something for everybody on this call to know. And I had to look it up just so I make sure I get all the categories. But for a real estate property trade, that's the business you have to be in, at least 50%. That includes construction.
Mm-hmm.
So if you're in the construction business, you qualify for rep status. And then acquisition, rental, operation, management, leasing, brokerage. It doesn't count activities like searching for property, That doesn't count towards your 750 hours. That's the other piece you also have to have, at least 750 hours. So that person that is, they're single and they're a realtor, they can qualify for rep status. They're single and they're in construction, they can qualify for rep status. They're single and maybe they're a freelance IT worker and they're only working 20 hours a week. Well, they could conceivably have more than 20 hours a week in real estate and qualify for rep status. And what that does is when you qualify for rep status, it changes the nature of your real estate income. It is no longer passive income. And you all may be familiar that there are passive activity loss rules for married filing jointly. If your income is at $150,000 or more, you can no longer claim any losses from your passive activities. Of course, if you have been following Michael, and if you've read One Rental at a Time, you know you're not supposed to be losing money in real estate anyway.
That's right.
No alligators out there, people. We
Come
want to
on.
be making money.
That's right.
But let me get back to passive versus active income. So you are limited in the passive losses you can take. But when you qualify as a real estate professional, that income from real estate now counts as active income. And if there is a loss, it can be applied against your ordinary income, your W-2 income, interest and dividends, etc., regardless of how high that income may be. So there can be a real benefit to it, but I'll have a conversation with someone who asks me about reps, and the conversation is always around, but isn't the goal to make money in real estate? So let's first make sure that we're doing all the things we can do to maximize that rental income. I don't want to do anything to limit that so I can qualify for reps and have a loss to apply against my other income. That just seems backwards and not why we're in this.
Right.
So your second scenario, though, that's a really interesting one. The person who's
Exactly.
married. So I'm married, and my wife, she is the sole member of the LLC that owns our real estate. She does not qualify as a real estate professional. She doesn't have 750 hours. She won't have 750 hours. But let's suppose she did. I'm an accountant. I have my W-2 income. I'm over that $150,000 of income for our married filing jointly, so we can no longer claim any passive losses. If my wife qualified as a real estate professional, we could then do a cost seg study on a big property and claim a loss against my W-2 income, and that can be a real benefit. Again, we would do that in concert with a plan for where we're headed with our real estate investing.
Yeah. And you guys know, Lumberjack's a big part of the channel. He's shared with me that in his relationship, until he retired, he was the big W-2 owner and his wife was the real estate professional. So again, it can happen. Generally speaking, folks, if you're a high-tech worker, 60 hours a week, I know a lot of you keep asking, how do I? You don't. Move on. Right? It's not there for you.
And
As a
let me
single
just
person.
say this about Matt, since you have brought him up. You guys probably haven't had the benefit, maybe Michael has, of meeting Ashley. She is both the brains and the beauty of that operation.
Yeah, absolutely.
I mean, she is extraordinary in her knowledge of the properties and what she does there. And so it is a fantastic example. I can't get into specifics, but Matt has on his channel of what they've been able to do with growing their portfolio with her as a real estate professional and the tax benefits that they've received. So it is an excellent strategy if you are married and your spouse qualifies.
Absolutely. Absolutely. Well, Joe, you got your hand up again, buddy. What you got?
Yeah. So on that note, that was really helpful on the active versus passive. My question is more around short-term rentals where the average stay is less than 7 days. And I just want to throw out a hypothetical situation. Say I were to purchase a $800,000 home in Dallas where I live and make it a short-term rental and materially participate through managing that short-term rental. Obviously, my understanding is the bar is lowered from, I think, 750 hours to 500 hours, maybe it's even 100. The clarity would be great. And then let's say I were to do a cost seg study, take 60% depreciation as a loss against my W-2 income this year. How much length of intent that I would have to show the IRS before I were to hypothetically move into that property? Like, would I have to keep it a short-term rental for 2 years, 3 years? And if I eventually ever wanted to move into that property, what would that look like?
I see. I see. That's an interesting question.
Not
So
not
there's kind of,
sell the property to myself again, but maybe like put it in a land trust, make the LLC a beneficiary, make myself the beneficiary. Is that a hypothetical situation?
okay, so let me kind of address two things here. One is what we refer to as the short-term rental loophole, which you kind of
I-
described. And then two, I'll discuss moving into a rental property that you've owned. So what we call the short-term rental loophole, that is a property that you are renting out 7 days or fewer, and that changes the nature of the income. It now gets reported on Schedule C, which
Yep.
is where
Versus
you
Schedule
report
E.
small business income.
Yep.
And that's a potential problem, because if your short-term rental makes money and it's reported on a Schedule C, you're now subject to self-employment tax on that income, right? So you want to be careful with it. But in the case where you are doing a cost seg study and you are taking a loss, it's a loophole because your Schedule C loss always applies against your active income. So that's where it's a benefit. Unlike your Schedule E for your rental property, where it doesn't apply if you're over certain income thresholds and is limited below those income thresholds, you do have the benefit of being able to claim that loss against your income. Material participation is 500 hours. And so with the short-term rental scenario, you are typically doing more services. Maybe you're doing some of the turnover. And the 100-hour, and I wanted to get the language right, the 100-hour caveat is you participated in the activity for more than 100 hours during the year and at least as much as any other individual. So that's where if you've got a cleaner and they're in there 4 hours a week cleaning, you've got to make sure you're working more hours than that cleaner in that in order to qualify as materially participating. It is a great strategy, and there are two ways that people go with this. So one strategy, Joe, is you buy the property, you do the short-term rental loophole to take this loss against the rest of your income, and then you move it to a long-term rental so that you don't have to worry about the taxation of the self-employment tax issue with short-term rentals. So that's one plan. The second issue, though, that you brought up is, and I'll kind of separate it a little bit from the short-term rental question, and that is, if I buy a rental property, can I move into it and make it my primary residence? And then what does that look like? And this is a question related to 1031 exchanges also. And the answer is the IRS doesn't have a specific number of months or years that you must live in a property before you can make it your primary residence. What they care about is intent. So clearly, with your short-term rental scenario, you have showed intent. You have rented it out, you have claimed that income, and then you can move into that and make it your primary residence. It is a tool that people will use. I'll say that it's legal but aggressive on a 1031 exchange to 1031 into something like a lake house. Here in Maine, we have some beautiful lakes. We could 1031 into a property and then retire to that property in 15 years, rent it out in the interim. It's completely legal. Is it aggressive? Perhaps it's aggressive, but the IRS is aware of the strategy. And we would then have a step up in basis, of course, when we sell that property. When we pass away, and our kids sell that property. So there are a number of these you can kind of tie together to have some tax benefits, at least with the tax law the way it currently stands. Did that answer the question, Joe?
It was very helpful. What would be a good length to rent it out as a short-term rental to show intent?
I would
Roughly.
say a year.
I'm not going to hold you to it, but maybe a good range.
Yeah,
I would
you've
say
got to
over
get
A
through
year
at least.
after that
a year.
deduction.
Yeah. You
Yep,
got to
at
get through
least
the
a year
tax
would be
season.
good. Yep.
Yeah.
That's interesting. Okay. And then would there be any recapture of depreciation once I move into that, or only when I sell that property? And if I do sell it, I would have to recapture the depreciation, but
when you sell the property.
Yeah, when you dispose it.
Yep. And it's the same, interestingly, for a home office. So some people that work from home will depreciate the house as part of the home office deduction. Then when you sell that home, you do have depreciation recapture on that small amount that you're claiming for your home office as well.
Yep.
Okay.
Very, very
Very helpful. Thank you.
All right, Joe. Thank you, buddy. Lars, round two. Let's go.
Yes, thank you. So I have a question in regards, so my son is um high functioning Asperger's, and he's looking to go to school, and I was thinking about co-borrowing for him, and for him to have a house and get roommates and that kind of stuff. But I was also going to set up an LLC to be so I can manage the property but not have his roommates know that he, is the owner. Um how if I did that for taxes, would all the income, would the LLC be paying the taxes instead of myself? Is that how that would work? And are there any disadvantages to setting up that way that I should take into account before executing this strategy?
Okay, so let me ask you this follow-up question, Lars. Would you be the only member of the LLC, or would your son also be a member of the LLC?
It'd probably just be me and my wife.
So if it's just you on the LLC, that would just be reported on your 1040 on Schedule E, like any other rental property, because it's a single member LLC, which, big picture, an LLC does not have a tax return. It is just a state level entity that gets created. And then how you treat it determines how it gets taxed or not taxed. Most LLCs are pass-through entities. So if you and your son were members of the LLC, then by default, an LLC with two members or more is a partnership. It would have its own tax return. It wouldn't pay tax because it's a partnership. The income would flow through to you and your son. But in this scenario where just you are the member of the LLC, it would be reported on your tax return, and it would get taxed at your rates.
Okay, so fairly normal stuff. Nothing. I'm not putting myself in a bind in any real way. Okay.
No, and you're right to think in terms of an LLC. Again, I can't offer legal counsel, but having college students in a home would probably be a
Yeah.
very good reason to
Create this
limit liability.
separation. Yeah. Yeah. Very cool. All right, Lars. We're going to go to Jason next, but first we're going to just going to go back to Matt, the mortgage guy. He wants to know about how long, or is there a limit to how many years for the offset? This is back to the loss. You were talking about $3,000 loss, like, passive loss against active income. Is there a number of years that you could take that? How long?
Carries forward indefinitely until it's used up.
Indefinitely.
Yep.
Exactly. I had that from the .com crash, so I remember that vividly. It took over a decade.
And there is another piece to that too that I should bring up. So if your rental property, so that scenario was with a syndication that had a passive loss.
Correct.
But
Correct.
if you own a single family home and it's just been a money pit,
Yep.
and you've got these passive losses every year and you can't take them because your other income is too high, when you sell that property, you are then able
absolutely
to use all those passive losses from that property against the income from the sale of that property. So that is another passive loss.
Believe me, I did that for a property in about 2018 because it was a money pit, and I'm like, well, I'm gonna, so you could do that. That's why you got to work with an EA like Bob Langworthy. He talks through all these options with you. All right, we're gonna go to Jason. Jason, your hands up.
Hello, Bob.
Hey,
nice to meet you. I heard plenty of good things about you. Thank you for doing this for all of us. I have a S corporation, a W-2, and I just bought real estate in February. Is it okay for one tax accountant, to do all three of them? Because that's how I currently have it set up.
Yeah, that's a great question. And the answer is yes. In fact, we prefer whenever possible, and perhaps your accountant does too, to have all the returns for an individual, because that's where we can really provide some tax planning opportunities.
Exactly.
So if you had somebody else doing the S corp, but they weren't really fully aware of what's going on with the real estate, it wouldn't be a good, there's the potential it wouldn't be a good tax situation for you. So yeah, having it all in one place is great.
Totally agree.
Okay.
Totally, definitely. Totally agree. Thanks, Jason.
That was pretty much it. Thank you guys very much.
All right, buddy. Take care. Hey, we're going to go a question from Mark. Again, I have done cost segregations. I have used the firm. I forget what they're called, cost segregation. They've been on my channel before. I've used them. Now, because of technology, They've actually come out with these do-it-yourself type cost seg studies.
Yes.
Bob, have you heard of these? What are your thoughts on them? I certainly have my opinion, but I'll let you go first.
Yes, so I have used, there is a company, I'm not endorsing them, just mentioning the name that I have used called DIY Cost Seg. You can look them up. And I have used them. And the reason that I'm okay with using them is because in the audit guidelines for the IRS, they mention a rule of thumb. And the rule of thumb is basically 15% for 5-year property and 10% for 15-year property. And so there is at the very least a high level rule of thumb calculation that somebody could use. We wouldn't use that, but that can be used for a cost seg study. So when these firms come in, and I looked into this with this DIY cost seg because I have a lot of real estate investing clients, and I can at least say for this particular firm, they have done thousands of cost segregation studies in person, engineered studies. And they are using that database to say, based on all of this information that we've compiled over the years, we are going to do, they have their own kind of proprietary metrics that they use, the proprietary figures that they use to produce your cost segregation study. I've looked at a couple of others that I think there's at least one other big one out there, and they'll typically offer audit protection as well. And if that makes you feel comfortable to buy the audit protection, go ahead and do that. That would cover their services if the cost segregation in particular was questioned in the audit, not if you got audited,
Right.
but if within an audit they were actually questioning the cost segregation study. I represented a client recently with a cost segregation study as part of their audit, and the IRS the agent didn't really care about that. And here's the reason why. When you do a cost segregation study, you're actually correcting the way that depreciation gets calculated. If it's an older property, if it's not the year you put in the service, but it's a year or two after that, we have to fill out a form 3115 and explain what we're doing. And our explanation is this property was being depreciated over an improper life and method. And with this correction, we are now correctly depreciating this property over 5 years and this over 15 years, because it's not correct to depreciate that paver patio over 27.5 years. And so you're basically confessing your sin to the IRS. In return, you get this tax benefit of increased depreciation. So I am comfortable with those firms. I don't know how large a building I'd be comfortable with. I did it on my 4-unit. I don't have a 20 something or 100 unit property. I'm sure there's a size at which you're going to want an engineered study and somebody on site because it's very particular. I haven't done it on my office building, in part because it's 8 years old now. And I don't know if there's a firm that does kind of that DIY model on commercial properties or on self-storage or something of the sort. But definitely worth it also if you own a mobile home park. There's a lot of land improvements for the mobile home park, and you can really reap the benefits there as well.
Very, very cool. Folks, I have been through an audit. I have had cost segregations. I personally would never do a DIY. No, thank you. The last thing I want to do is not have the engineering study in the backup. But again, that's just my personal opinion. I am not an EA like Mr. Bob Langworthy. So he has a few more discretions there. Mr. Martin Weiser, you got your hands up, and I see you had a comment about short-term rentals. So I'm going to guess it's the same thing, but go ahead.
Yep, exactly the same thing. So kind of a follow-up to what Joe asked, but basically how serious does the IRS take that average stay? So there's a couple of potential laws in Colorado, for example, where if you get around 90 nights or 120 nights or 60 nights, but they don't know yet, like property tax changes. So people are already figuring out, well, then my short-term nights are going to be below that. But then how does like a medium stay factor into this whole equation, I guess?
Well, the 7 days or less, that is the rule for what qualifies as a short-term rental. So on the federal level,
so basically you just add up like one night, 7 nights, 32 nights, one night, and you calculate the average literally like that?
Yes. Yep. It's the average stay. Yep.
Got it. And there's no wiggle room where you say, hey, I'm going to do it by revenue or by, some other metric, but the average stay by revenue is still, below or above a certain amount of nights?
No, it's just the average number of
Okay.
nights. Yep. Yep.
Okay, cool.
Yep.
Very, very cool. All right, we got a question about basically finding a good bookkeeper. Any recommendations, Bob, on somebody who's got a lot of receipts, a lot of paper coming and going? They're looking for a bookkeeper. Any advice on how to find one?
I would say it's a challenge right now because not a lot of people are going into bookkeeping and accounting. But one of the benefits of living in 2024 is that it's easier than ever to have someone do it remotely. In fact, most of the people on this call who use a bookkeeper, it probably is someone remotely, not somebody right in their town. So I don't have names of any national firms. I know they've got to be out there. You're going to want to interview them to make sure that they have handled real estate before. There's not a whole lot that's different with bookkeeping and real estate, but you're going to want to make sure, back to our question earlier, that they know how to read the statement from the property manager and are entering things correctly into QuickBooks. You're going to want to make sure if you have multiple properties in one LLC, it'd be great if that was all in one QuickBooks file and they were using classes to track. So for my own properties, we have my bookkeeper at the office. We use QuickBooks Online, and it's a separate class for each property. So it's very easy to see when we run the P&L by class. So here's how this property did, and this, and this, and this. And you'd want to see something like that for your properties if you have multiple properties. That is a higher level of QuickBooks Online that you have to pay for. Kind of a related question that I'll answer is regarding bookkeeping software. And I'm always hesitant on any of the property management software that's out there. There's some of it that's free or virtually free, but are you really capturing all of the transactions, or is it just the rent that gets paid that you're capturing? And that's where a third-party software, something like a QuickBooks, and I mention QuickBooks only, and I'm not endorsing QuickBooks. I don't get paid by them, but they are very widely used. Any question you have about QuickBooks Online has been answered in a YouTube video. It's fairly easy to set up, and a lot of bookkeepers use it. So if you were to transition from one bookkeeper to another, or to a bookkeeper for the first time, QuickBooks Online would be a good place to start. There are probably other great packages out there. I'm just not familiar with them.
Yeah. Well, let's talk about how somebody would work with you in Maine Bean Counters. Let's say you're watching this channel, you're watching this video, you're a newer real estate investor, you have a couple to a few. They reach out to you. How does that interview go? What are you looking for? Because I know, you do have this interview process. So talk about what you're looking for in a client.
Yeah, great. Thank you. It's a good question. So the first step, they'd probably reach out through the website, mainbeancounters.com. You can find me on LinkedIn, Bob Langworthy, and I'll direct you either the website will direct you to our office manager, or I'll direct you to Amy, our office manager. She's that one point of contact for everybody that comes in. She schedules the screening calls with Jason Alba. Jason is a CPA, real estate investor that works with me because he has more time in his schedule right now than I do in mine. And the types of questions that he's going to ask, he's going to want to know how many properties you own, how long have you been doing this. You don't get screened out if it's a certain number. If you only have one, that's fine. If you have 100, that's fine. But he's just going to want to know a little bit more about you. He's going to want to know about your full-time job, if you have it, your marital status, your kids, all these things, so we can begin to put together a profile of who you are. And then he's going to ask about things like bookkeeping. How carefully are you tracking everything? It doesn't have to be in QuickBooks. We have clients that keep their own spreadsheets that are very detailed, that are fantastic. We have a very simple spreadsheet template that we'll send to people that only have a couple of properties, and they can input their information into that kind of in summary form at year end. But we're going to want information coming to us at year end for the tax return in Excel. And if it's, any bookkeeping software can be exported to Excel, so that's fine. You don't have to send us a spreadsheet. And from there, if it seems like he'll talk about price, he's going to want to know what state you're in, what state your properties are in. There's some complicating factors, with real estate investors at times. And then from there, if we're a good fit for one another, you get handed back to Amy. Amy will send you a welcome email, an invite to our client portal. We'll want to see 2 years of tax returns. That tells us more about you. And it also gives us the detailed depreciation schedule, because we need to continue the depreciation on the schedule that it's currently on. And that's basically it. As I said, we do work with a lot of real estate investors. and small business owners, because those are frankly more interesting tax planning opportunities for us, and we can provide more value. And our real estate investors, they really do run the gamut from, one property to, 100 or more properties.
Yeah. The other thing to really talk about is how often would you want to talk with one of your clients? Obviously, you're going to talk to them probably early in the
Yep.
year, January,
Yep.
February, probably going to execute creation of the tax plan in March, probably have a review period. But do you want to talk to someone in the summer? How often do you kind of talk to your clients?
So there are basically two outside of tax season and reviewing the tax return. There are two times when we're definitely going to want to talk to a client. One of those is going to be around a property transaction. We're going to want to make sure that that's being handled well, whether it's a purchase or a sale. It'd be great to just loop us in for it could be 15 minutes.
Yep.
That's fine. We just want to make sure that we have the information that we need, and that we've communicated anything that client may need to know. They may be forgetting about depreciation recapture if they're selling a property outright.
Yeah, because you could tell them, hey, just so you know, FYI, this is gonna happen.
Yes. Yep.
Yeah.
Yep. And then the other time, we typically do our tax planning calls towards the end of the year, October, November, December, that time frame. And so it's good to touch base if you have a more complicated scenario towards the end of the year, so that we can discuss what you might do or not do for tax planning purposes. Now, let me go back to the cost segregation study. One of the great benefits of the cost segregation study is that it does not have to be done within the calendar year.
Correct.
So if we get to January, February, March of 2025, we're working on your 2024 tax return, and it looks like, boy, this would be a great year to do a cost seg study on this property. Great, we do it in March. And we add it of 25, we add it to your 2024 tax return. So it's yet another benefit of a cost segregation study, that you don't have to hurry up and get it done within the calendar year.
Yeah, a lot of great stuff. Well, Bob, thank you for doing this. You're amazing. You're always there for me when I have questions. You help so many of my friends. If somebody wanted to reach out to you, what is the website?
The website is mainbeancounters.com. Maine like the state, bean counters like accountants. That's who we are. You can find me on LinkedIn. I am Bob Langworthy. My picture looks something like this, but maybe with glasses. And yeah, you can reach out to our office manager, office@mainbeancounters.com. And Amy can get you in touch with our team.
Very cool, Bob. Thank you for being here. Thank you for always saying yes and being so flexible for one rental at a time, man. You're amazing. Take care. Thanks again. Later,
Thank you
guys.
all.
Bye.